Do you want to know the number one key performance indicator that will help your e-commerce business? Hi, I'm Patti Scharf, CPA and partner at Acuity. Today we're going to talk about contribution margin, what it is, and how understanding it can drastically help your e-commerce business. Okay, so I pulled out my spreadsheet for demo because I just think it's going to be easier to explain it when I've got something to look at and you've got something to look at. When you are looking at the income statement for an e-commerce business, there really are probably four big categories of costs and income that are associated with an e-commerce business. The first is revenue. That's going to be the products that you sell, the money that the business takes in from selling the products. Okay. Next up is going to be cost of delivery. These are all of the costs that are associated with getting the product and sending it out to the customers who purchase the products. Okay. Ad spend, this is going to be things like Google AdWords or Facebook ads, things that you're spending money on for ads, ad spend. And then the fourth category is going to be operating expenses. These are the costs just to keep the lights on. It might be rent, it might be wages, salaries, things like that. But these are the four primary buckets. All right. Now, before we talk about contribution margin, which I realize is showing on here, I want to talk about variable costs versus fixed costs. So if you are looking at the first grouping of this cost of delivery, so the things that I just talked about, the materials, the inbound shipping, fulfillment, all of those kinds of costs, all the costs associated with delivery, these numbers are going to change based on the number of widgets that are sold. So let's say you are selling 5,000 widgets. You would have associated costs like this. So let me actually expand this out so you can kind of look at what I'm looking at. All of these costs that are variable, as you're selling more, the costs go up. As you sell less, the costs go down. So if you pay attention to these numbers, you'll see that they change as I'm changing the quantity. But you know what's not changing are the per unit costs over here. So you can see that those are staying the same no matter what numbers I'm putting in here. Okay, so that's how you can tell those variable costs, right? The fixed costs, on the other hand, they are, not surprisingly, fixed. They don't change. It doesn't matter if you sell 1,000 widgets or you sell 10,000 widgets. The fixed costs are going to stay the same. All right, so now you understand the difference between the variable costs and the fixed costs. What is contribution margin? Contribution margin is revenue, so this number up here, minus all of these variable costs to come up with your contribution margin. There is also something called a contribution margin per unit. So this is kind of what we were talking about before. What this is telling you is that for every unit that you sell, you're going to make $1.70 in this case. So if you sell more, let's say you sell 10,000, you're going to get 10,000 times $1.70 that's going towards covering your fixed costs or coming out to you as profit. All right, so hopefully that all makes sense. Once you have the basics here, you can start doing some pretty sophisticated calculations and analysis. All right, so the first thing that you can do is you can take a look at your break even. So this is a very simple case. Again, it assumes one widget, one price, selling in one place. And let's say you are selling 1,000 units, you're going to have a loss. If you're selling 5,000 units, you're going to have profit. So what is that break even point? And I think in my case, I think we figured out it's like, yeah, $3,442. Okay, or not dollars, 3,442 units. So when you sell that amount, anything above and beyond that becomes profit to you. You have now covered all of your operating expenses by selling that amount at that price. Okay. So now some of the things that you can start doing are some pretty sophisticated things. So the first thing that you can do is you can figure out your pricing strategy. Obviously, you want to make enough that you're covering your costs. And let me just warn you before we get into some of the other analysis stuff. I want to warn you about bad pricing. If you take a look at this, where you've got a negative per unit contribution margin, that means that with every additional unit you sell, you are losing an extra $4.41. So if you sell 3,000, you're losing more money than at 1,000, and at 10,000, you're losing even more money. So you cannot outsell a pricing problem like this. So this is what makes it really key to understand your contribution margin on a really basic level. Now, as we get more sophisticated, you can start doing things like this. You can take a look at not only the basic scenario, but you can break it up according to different channels you're selling on. If you're selling on Amazon, Shopify, eBay, or others, if you are analyzing the different costs and you are segregating, oh, okay, I've got these costs associated with Amazon, these costs associated with Shopify, these costs associated with eBay. Now, suddenly you can find out, oh, which one has the highest contribution margin? Which channel is contributing most to my bottom line? That's a number that you really want to pay attention to, because you might want to throw more ad spend at the channels that are doing well compared to the channels that are contributing less to your bottom line. Something else you can do is you can take a look at the profitability per SKU. So take a look at your contribution margin per unit for each of your different SKUs, and you can see which of your products is contributing most to your bottom line. So sell more of those because you get bigger bang for your buck. The ones that have smaller contribution margins, they might be more price sensitive. You have less wiggle room to work with when you're playing with the pricing and things like that. You can also take a closer look at the different costs that are contributing most to reducing your contribution margin. So if your outbound shipping is through the roof, maybe if you can reduce that, you can increase your contribution margin, which will have an impact on your bottom line. All right. So I think that should give you a pretty good overview of how all of this works. I want to make one last comment before letting you go, which is fixed costs. I think a lot of people, when they're talking about variable costs versus fixed costs, they sometimes forget that fixed costs, just because they're fixed, doesn't mean they can't change. If you think about, as your business grows, you might need additional help. You might need additional storage. You might need to buy a warehouse. All of these things are totally predictable that you could actually need to do. So make sure that when you're paying attention to your contribution margin, every once in a while, you should take a step back and look at it big picture and make sure that your contribution margin is still covering all of your fixed costs as your business continues to grow. All right, I hope you found this useful. If you did, please like, comment, and share. If you haven't already, please subscribe, and I'll catch you later.